Thanks for joining for a video update on the portfolio's performance and our outlook with myself, Dan, and Joe, the Endeavour investment team. So first, we've just got our returns here since inception. In FY24, growth was up 13.6%, balance 13.4%. The market was 12.5%. These consistent outperformance numbers really add up over the long term. And you can see here since inception, the balance portfolio is up around 92% and the growth portfolio 130% after fees above the market. Now, the high conviction portfolio, we made a change in October 23. I took over as portfolio manager, supported by Dan and Joe. And since then, you can see in this chart, we had a bounce in the portfolio and the market. The market was up 17% since that period. The high conviction was up 24%. And for the financial year, because we had a pullback before October, the financial year return was 11.9%. So slightly under the market there. But we're confident we can claw this portfolio back to the all-time highs and beyond based on what we're seeing in the market at the moment. And we'll explain in a little bit more detail some of the things we are seeing and why it gives us confidence about how we're positioned and our performance into FY25. So the first thing to talk about is inflation. We all know the story. Inflation was rising. It got up to 9% in the US, 8.5% in Australia. Since July 22, it's been in steady decline. US is down to 3%, and Australia recently has seen a little tick up. So we've got this environment where there are cuts almost a certainty in the US, priced in by the market, and some investors are pricing in hikes in Australia. We think Australia is just generally lagging what we're seeing in offshore markets. The RBA was reluctant to raise rates as aggressively as offshore markets, and now we have a bit of a stronger economy, slightly stronger inflation, and we almost are having an insight into the future by witnessing what's happening in the US with laggard sectors starting to move higher, like biotechs and small caps and real estate, especially those that have been impacted by higher interest rates and mortgage rates. This next slide's another example of what we've been seeing. 2021 and 2022, those red columns there, that's hot inflation, and the rows are countries. So we can see that inflation story we've talked about was not unique to Australia. This was a global issue post-COVID stimulus, and recently it's been cooling. Australia is still hot-ish, but getting cooler. China does not have an inflation problem, and US has been steadily declining. Now, there's some interesting dynamics playing out in the market beneath the surface. Obviously, broader indices have been rallying strongly, led by big caps. And we actually have seen earnings growth in some cases outpace the share price movements. This is a good example from the Australia 100 Industrials Index. The red line, the PE multiple, quasi-valuation for this index, was 22.5 times. It's now 20.5 times. So the multiple is lower, even though the industrials index is moving higher. So we're seeing earnings upgrades coming through. And this is a trend in many markets and industries that we're looking at. Something else that we've been talking about and watching for a long time is this underperformance of the small companies versus the big companies. Since June 21, the small ords is 20% under the all ords. So again, the movements in the market has been driven by the big caps. We're now starting to see this reverse. A catalyst has been inflation dropping off in the US, rate cuts priced in, and we can see here the Russell 2000 starting to rally relative to the S&P 500. We think this trend continues. We think small caps are set to outperform. We're confident in this because of the valuations we're looking at in some of these smaller companies. There's been a flight to bigger caps, more perceived defensiveness over the past few years. But in Australia specifically, this has created a dynamic where a lot of these defensive companies are too expensive. For example, we have CommBank, which is now the biggest company in the ASX, trading on 25 times earnings, 3 times book, 0% earnings growth. Meanwhile, there's some quality companies that we own that we think are cheap relative to offshore peers. So we might talk about a few of these companies we own, some that have performed well in FY24, some that didn't, and what we're doing about it. First one, over to Dan on Webjet. Dan's an analyst that joined us early this year from Thorney Investments, been a great addition to the teams, done a lot of detailed work on Webjet. So maybe Dan, just concisely, if you can talk about the investment case, why we own it, and what we're doing going forward.
Thanks, Hayden. So we invested in Web in October 2023, and pretty much there's two businesses within the one. One is the B2B business, which we think is significantly more valuable than the B2C business. The current share price probably is only really accounting for that B2B part. With that said, now the business is basically undergoing a demerge of those two businesses. So we'll get a large chunk of the good one and a chunk of the not so good one being the B2C one, and we will continue to hold the B2B one going forward. Basically, the current share price is underestimating, I think, how good that B2B part can be going forward. There's probably at least another 15% upside to that division once it does demerge and spin off, and we continue to hold that all the way through.
Next one is Zip. This is a business we bought in December 23. We thought it was performing better than the market was giving it credit for. It was down 95% when we first looked at it, and the new CEO impressed us. She had simplified the business, and the results are obvious. They'd increased margins, they'd divested loss-making divisions, cleaned up the balance sheet. Meanwhile, investors had given up on the stock. The sell side had given up on the stock. There was limited interest, and we thought they were turning the business around. We started to buy around that 40 to 50 cent range and took profits soon after. And we actually completely exited around March 24 and then bought back in shortly after when the share price sold off. We bought in around that 110 to 130 range. We recently participated in a capital raise to further reduce balance sheet. They paid off all the debt, and that's contributed to a big increase in their margin over the next financial year. They've also entered the ASX 200, and there was some passive money that's index buying money that was forced to invest, which was another reason for the capital raise. It's had a good bounce today. We're taking some profits again, but it remains a core holding. It's in our top 5 positions. We think this can reach a level of $2 to $2.20 based on our valuation estimates. We continue to hold. Next one is Life360. We won't go into too much detail. This was a good contributor to the portfolio. This is in the bucket we talked about earlier in terms of being a quality company. We think it's undervalued compared to global peers. It is cheap considering their penetration and their lack of revenue relative to their customer base. So we think they'll be able to increasingly monetize their customer base. We think it's a great value-add product. And we have recently been trimming just based on share price appreciation, but continue to hold this, and we expect it to be a good contributor this year. Next one is Neuren. We'll hand over to Joe Carlton, analyst at Endeavour, to talk about Neuren. He knows this company very well. Maybe, Joe, just for some investors and clients' benefit, can you give a quick summary of what this business does and why we like it?
Yeah, sure. Thanks, Hayden. So for those unfamiliar, Neuren Pharmaceuticals is a biotechnology company focused on developing therapies for neurological disorders, particularly rare conditions in children. And we first started buying this company around February 23, around $8 a share. Prior to that, they didn't have a commercial drug. Shortly after, they got the approval from the regulator to sell the drug in the market. Neuren's sales partner, Arcadia, gives Neuren royalty revenue on sales of that product. But also in the pipeline is the second drug, which can be used for therapy for 3 other rare neurological conditions. Now, these 3 other conditions are multi-billion-dollar markets, and the company has been undergoing clinical trials, which so far, the outcome of which have looked excellent. We see more catalysts ahead with the company conducting more trials, with the final trials before the drug can be commercialized. As well as that, we've got multiple sales milestone payments in the pipeline, as well as the royalty revenue. The balance sheet's in good shape, and the valuation is attractive at these levels. We've been buying recently.
We also think the sector is poised to outperform, being biotechs alongside, like we mentioned earlier, sort of real estate, small caps, with rate cuts coming through. And this is just a healthy dynamic we're seeing in the market, this rotation out of winners into laggards. Rotation and increasing breadth tends to drive bull markets higher. Money is being rotated into underperforming sectors as opposed to being taken out of the market, like we see in risk off periods, like in FY22 and 23. And we've owned Europe for some time, but we've recently increased for sort of bottom up exposure and top down sector exposure. Now, some of the losers that impacted performance in FY24, we'll talk about two of those. Lifestyle Communities was one. Investors and clients of Endeavour will know this story well. We were in, we were out. Maybe, Joe, can you tell a little bit of the story?
Yeah, sure. So we caught up with management in the first half of the financial year, and the mood for management was positive. They sort of spoke to some early signs of a property turnaround, and it sounded like sales activity was strong. So we went back to the desk, spoke to our network, and did some valuation work and took a position. Now, what we saw after the first half was some signs that the property turnaround wasn't fully here yet, with the settlements part of the lifestyle business delayed, which impacted the cash flows. Now, what that happened there was it saw our internal valuation decline. So we exited the stock. The price is now 37% lower versus our exit price. So that ended up being a good decision.
Thanks, Joe. It was a timely exit, although it was disappointing being a detractor to the portfolios, but we're pleased we got out before it declined further. They've recently been hit by some negative sentiment in the media. There's some customers, the owners of some of their properties in a specific development that are complaining about some aggressive sales tactics and the DMF, which is the deferred management fee, which is a core part of their business model. So we've had this period of a downgrade, which was just after a capital raise, followed by negative sentiment, followed by weaker regional property in Victoria. And now we're seeing some emotional selling. When selling gets emotional, it tends to create opportunities. So we're obviously watching closely, meeting management team in a few weeks in reporting season. And never know, this might become attractive once again and find its way back into the portfolios. EML Payments was another slight detractor. It's a recent entry. This is a business that has declined, and following the decline and turnaround, we started buying shares. We think there's some value there. Dan has done a lot of work. Dan, do you want to quickly give the investment case?
Yeah, so EML is a global payments business, and basically throughout 2024, they divested two divisions overseas that were problematic during the year and the years prior. With them now gone, the business effectively returns back to 52 to 58 mil of EBITDA for FY24. It can then grow from there, and we're expecting that to get to about 65 mil of EBITDA by FY26. That puts it on sub 6 times EBITDA, and for a business like this, we would generally expect it to trade closer to 10 times EBITDA going forward. So we see not only profit growth upside, but upside in the multiple expansion too. We recently bought some more below $1 based on weakness in the share price, and we're comfortable holding it here going forward.
Yeah, thanks, Dan. Yeah, we are at full weighting, and being a turnaround, it can often take time and often take longer than is expected. So we've been buying the prices under our average buy price, but we're confident that they have turned the business around. The next results should be much cleaner, should attract a new round of investors, considering it's a story that's a complicated story previously that now is a bit easier to understand, and we have valuation support here. So that's it for the companies and the majority of the presentation. So just quickly on what we're seeing, sort of described in our early slides, that returns will be stock and sector specific. And the market is probably as stock specific as we've seen it. There's a lot of interrelated macro dynamics playing out. We've put political certainty here as a question mark because it's always up for debate. But following the weekend's events with the attempted assassination, it looks like the odds of Trump having control are very high. And that has various implications for US markets and the globe. Pro-growth, pro-spending, maybe slightly higher inflation, maybe interest rates lower than they should be considering higher inflation, but as a tilt towards capitalism and should be positive for company earnings and equity markets. In Australia, we're seeing some weakness creep in consumer-facing sectors. In the recent jobs numbers, there was weakness in hospitality, retail. Consumers are being impacted by higher rates, even though we're seeing inflation remain stubborn. But we're also seeing a lot of strength in the Australian economy, driven by our commodities, defensive companies, immigration, and as always, quality growth companies, regardless of what's happening in the economy, will continue to perform. And that's what we're seeing, earnings upgrades in the great businesses that we look to own. We feel we're well positioned into reporting season in August. We had relatively high cash weightings. We've invested those cash, a fair amount of the cash weightings are a bit above 10% at the moment. And we think the dynamics that are playing out with the rotation into the laggards sets us up fairly well into FY25 and beyond. So thanks for listening. As always, team's here to chat. We'll probably give another video update after the reporting season, and we'll speak to you all then. Bye.